How do you evaluate preferred stock issuer financial health? Imagine you're considering adding preferred stocks to your income plan. How do you know if the company issuing those stocks is financially strong enough to keep paying dividends? That's what we're here to find out. First, understand that preferred stocks sit between bonds and common stocks in a company's capital structure. They have priority over common shares for dividend payments and claims on assets if the company liquidates, but they are below debt holders. So, the company's ability to meet its debt obligations is key to its ability to pay preferred dividends reliably. Next, look at credit ratings from agencies like Standard & Poor's or Dominion Bond Rating Service. These ratings give an independent view of how safe the company is. Investment grade ratings, which are above the PFD 3 level in Dominion Bond Rating Service, suggest the issuer is less likely to miss dividend payments. Lower ratings mean higher risk, so pay attention to these scores. Then, review the dividend coverage ratio. This ratio shows how easily the company can pay its preferred dividends from its earnings. It is calculated by dividing earnings available for preferred dividends by the total preferred dividends due. A ratio above 1 means the company earns enough to cover dividends comfortably, which is a good sign for income stability. You should also examine the company's earnings and profitability. Look at net income, earnings before interest and taxes, and earnings per share trends over time. Consistent or rising earnings indicate the company can sustain dividend payments. Return on equity, which measures how well the company uses shareholders' money to generate profits, should be healthy compared to industry peers. Interest coverage ratio is another important factor. It is calculated by dividing earnings before interest and taxes by interest expenses. A higher ratio means the company can easily meet its interest payments, reducing the chance of financial trouble that could affect preferred dividends. Regulatory and industry factors matter too, especially for banks and financial institutions. Post-2008 reforms have strengthened their capital positions, making preferred stocks in this sector safer. Understanding these external factors helps you gauge the issuer's ability to keep paying dividends. Finally, check the market and redemption terms. Preferred stocks often have fixed dividends and may be redeemable by the issuer at certain prices and times. Knowing these terms helps you understand the risk of early redemption, which could impact your expected income. For seniors investing in preferred stocks for income, focus on issuers with strong credit ratings, solid dividend coverage, and stable earnings. Those with investment-grade ratings and a history of consistent payments are safer bets. Also, consider the tax treatment of dividends, as many preferred dividends qualify for lower tax rates, which can boost your net income. In summary, to evaluate an issuer's financial health, look at credit ratings, dividend coverage, earnings trends, interest coverage, and industry factors. This approach helps you choose preferred stocks that can provide steady income and reduce the risk of income interruptions.